Welcome to another Learn, Grow, Invest stock review and analysis. So today what we're going to do, actually it's IPO week. So we have the one-on-one IPO that has been released. It was released on July 29th. So on Monday of this week, we went through the prospectus review. And today, as we've done for the last few IPOs, we're going to do a financials review. And that's because we can't get through the prospectus review and financials review and do the interview all in one video. It's going to be a really long video, and we find that our audience, maybe it's kind of lengthy in that way. So we split it up into 3 videos for you. So I'll talk about that a little bit more after I start, but I want to welcome you. And yeah, let's just get started. Let's jump right in.
Learning is the key to successful investing. And who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at Learn, Grow, Invest.
All right, great. Thank you again for joining us. So let us pray. Thank you, Lord, for this day. Thank you for everything that you've blessed us with. Thank you for this community and that we're able to learn, grow, and invest together. Bless us with knowledge, wisdom, and understanding in Jesus' name. Amen. All right, guys, so I'm going to ask you, as usual, share the video. Please give us a like and yeah, let us get started. So I'm going to share my screen. I have some friends that will be joining me soon, but I think we'll be able to see them in a moment. So for this week, as I said, we did the prospectus review on Monday. If you missed that, definitely catch that. That's where we went into the details of the offer. I'm going to speak about them ever so slightly right now, just in case this is the first video you're seeing. Today, what you're seeing is the financials review. So this is all going to be about the numbers. We're not going to be talking about anything else but the financials. That's what we want to understand and dig deep into. And then tomorrow evening, we're going to be speaking with Ricardo Allen live here on YouTube. All right. So just to recap the offer a little bit, and actually just go through all of this. I'm just going to share all of this was what you would have missed on Monday. So I just want to speak a little bit about the offer. So what you're seeing here is the amount of money they're seeking to raise, 358 million. And these are the different pools. Now, the very first one that you're seeing here, the 108 million shares, that's going to Panjam and Sagicor. That's a loan that will be converted to shares, and that's going to be at 80 cents per share. This is the only group of shares that's going to be for 80 cents. Everything else is going to be $1, right? And we've seen that kind of standardization over the last few IPOs, that you're not having these discounts based on pool anymore. So what we have here are the different groups and the amount of shares allotted to those groups. And of course, the one that we get the most questions on is the teachers and trainers reserved. What was said is that you have to be a registered teacher with the Jamaica Teachers Association. They would have had to have you listed as a member as at the point of the prospectus being released. So if you became a member after, you're not going to be eligible for those pool of shares. And then everything else, we kind of went through that in the video already. I'll talk about just these again at a high level. So the opening date is August 12th. And as usual, you want to treat the opening date as the closing date. And minimum subscription, 1,000 shares with increments of 100. Price is $1, nice and easy to remember. Basis of allotment, we'll likely have a video to cover this once it's announced. That's going to be 6 business days after the closing date. Whenever that happens, you'll get your refunds 10 normal days after the closing date, and the listing of shares will be no more than 5 days after JSA approves. All right. And finally, I'll talk about the use of proceeds before we get into the financials. All right. So they're focusing on 3 things here. One, they want to be able to invest in what they call next generation learning content for new and existing markets. We didn't really, well, we're going to be asking Ricardo about this specifically tomorrow. What does this mean? What are they looking forward to hear? Next, they mentioned that they want to invest in adaptive learning technology using machine learning and AI to personalize learning, and finally to increase their working capital. Right? So that's the use of proceeds. And for everything else, like dividend policy, things like that, we covered that in the first video. Again, I just want to stress that this is not going to be a prospectus review. We're going straight to the MD&A to talk about the financials. All right. If you have any questions as they come up, feel free to post them in the comments. We'll take the questions at the end. All right. So, all right, Peter, this is 6:30 p.m. It is early, right? Okay. So let me get this off the screen here. So let's go straight to the MD&A. I'm just going to bring up those slides here. Just give me 1 second. Okay. All right. So what I'm going to do is just kind of read through the MD&A. So I'm waiting for Chike and David to join me. As soon as they do, I'll bring them on. Haven't heard from David, and Chike is having some internet trouble. So I'm waiting for them to join me soon. But we're going to look at the numbers now. Let me actually start with the Excel. So let me do this first. Let's just look at the numbers before we look at the details about them. All right, so all of this information that you're seeing here was taken from the prospectus. I've not added anything. I've not done any additional fields or anything like that. This is directly from the prospectus. I thought it would be easier to just navigate with it all being in one file, okay? All right, so let's start with the statement of profit and loss. Just give me 1 second here. Remove that for 1 second. Just checking to see if Chike or David have messaged me, or they're having trouble coming on. All right. Okay, no messages there. Show must go on. Okay. All right, so we're starting with the profit and loss. And so what we're seeing here, as what I've highlighted before, is starting with 2017. That's what we're gonna do our analysis from. We have revenues going from 27 million in 2017, well, fiscal year 2017, to 268 million. And so we've seen quite a jump from where they were in 2019. And let me know if you're able to see, by the way, if in case you want me to zoom in a little bit more here. So what we had was a jump from 36 million to 140 million. And what was mentioned about this is, of course, as you know, with the pandemic, there would have been an opportunity to provide services to schools, governments, etc. So they were able to capitalize on this opportunity. They would have had the infrastructure already to be able to do this. And all they did was just kind of, form those partnerships, and they were able to grow their revenue. What was even more interesting to see is that that's almost doubled in 2021, right? So that's what we're seeing for revenues. And on that note, one of the things that we see in the prospectus, we have this 12-month projected for 2022. Now we're able to see the 9 months for 2022. So they were about 72 million shy of what they would have done for the entire 2021 year, and they're projecting to far exceed that for this year. So that's what we're seeing here in terms of revenues. That would be extremely impressive, and that would be pretty much that's just about double what they would have done last year. 157 by 2 would be 314. So they would have done more than 100% growth on last year. All right, that's what we're seeing for revenues. 1 second here. All right, so for gross profit, that would be 13 million in 2017 and all the way up to 225 million. Now, your gross profit is pretty much that first line of profit that we look at after you take out your direct expenses listed here as direct costs. That's what leads to your gross profit. And so for them in 2021, it would have been 225 million. That's definitely, of course, something that you expect to see with revenues rising so much. And in a few, we're going to look at the margins, right? Because what's important for us to understand in these cases, not just the number, it's the margin in terms of that percentage that we're seeing, whether or not that is consistent with past margins. And of course, we're not really going to be comparing it to 2017 to 2019 because it's just, night and day in terms of the financials for those years. Next, we have admin and general expenses. This was definitely one of those that I'm watching here because what we see, of course, when revenues grow, you expect expenses to grow as well. But we had expenses going from 44 million in 2019 to 144 million. And of course, those are one of the things that we're going to go through to see if we can understand it a little bit more. Maybe we'll get some details as to how that is made up. All right, that's Chike backstage. Chike, you with me? Maybe try turning off your camera. I don't know if that will help. All right, Chike having some challenges, guys. Chike, try turning off your video. See if that makes a difference. All right, I'm going to remove him for now. Not sure what's happening there. Apologies for that, guys. All right, so this is one of the things that we want to dig into the makeup of these expenses. You usually see that information in the notes, so we're going to look at that. And let's see here, that's projected to be 194 million for the end of this year. So we really want to understand what those expenses are. I think it may actually make sense for us to try and find that now, since we're talking about it. So let me just see here. Because what we want to do is understand the makeup of those expenses, right? Because I mean, we understand that they might have added members to the team, but what we want to do is understand where those expenses are going. This is for 2021. Okay, so we have a little preview here. So this is admin and general expenses. So salaries we're seeing here. Hopefully you are seeing it as well. Yes, awesome. So we're looking at the one for 2021. So that's what we're talking about, and we can compare it to 2022. So salaries and related charges would have grown just in the 9 months here from 47 million to 63. Contracted workers, that would have decreased. Let's see here. Just focusing on the major ones, of course. Depreciation was one of them here. That's $1 million. And I mean, everything pretty much seems more or less here. Repairs and maintenance would have been reduced in terms of where they were last year. Gain and loss in terms of the this looks at maybe disposable jobs, or it just says gain and loss on disposal. I'm not sure what that is referring to here. Staff welfare would have been just in the million range, and security expense. So this gives us a makeup of the expenses. So we're understanding where the money is going. All right. 1 second. I think Chike is finally ready to join us. All right, Chike, I've added you, but all I'm seeing is a circle. Okay. So I'll leave it there for a bit. I'll put you on mute until you're able to speak. All right. All right. So that's what we have here. At least this gives us some idea as to what the expenses look like. So salaries would have gone up. I'm expecting here, team members would have been added. They would have been, I guess, expanding in preparation for the different divisions that they've outlined, and I guess the roles that they want to have for this new phase of the company. So I guess what we have here, if you combine these first two line items, that's about what? About 88 million in salaries and thereabouts. So as Peter saying here that Ricardo said he spends 60 million on research alone. Well, the research expense I don't think would be included in this. We don't see it as a list item here. What we're doing is just looking at the admin and general expenses to get an understanding as to where that money is going, right? Because that is what we want to understand and track it over time, right? So for hosting and license fees, I guess this would be related to their platforms, their technology that they have, whether web hosting, platform hosting, etc. Maybe online and cloud storage, all of that stuff. The legal and professional fees would have gone down, and advertising and promotion is there. That's, I guess, part. Well, no, not I guess, that is a part of running a business. So those are the ones that I've been looking at as the years go by to see how those are being managed in relation to their expenses. Of course, as I said, with growth in revenues, you expect growth in expenses. We just want to be sure we understand what that looks like. All right. Let's go back to the Excel. What they're projecting for 2022 is 93 million in profit, right? So where we're coming from here is 67 million in profit for the entire 2021. For the 9 months in 2022, they're at 40 million. So they're projecting adding 53 million to their profit, to their bottom line before the end of this financial year. All right, so that's what they're projecting, and let's actually have a look at that right now as well. All right, let's see. They had some projections here. Yep, this is it. So they're expecting that their gross profit will be 306 million. You're seeing it on the far right. They're expecting other income to remain where it is now, which is 9.4 million. And those same admin and general expenses that we just looked at, that's expected to grow by about 62 million for the quarter. That's what we're seeing here. And so operating profit from 60 million to 121. And then we have net profit being 93 million. So those are their projections. Of course, again, we have to wait to see whether or not they're able to meet this. What I would say here is that usually, based on where we are in the year, I think by the point of this prospectus, they should have a pretty good idea. I mean, we're in August now, so they've had maybe at least a month and a half in. So I guess based on their existing contract agreements that they may have in place, this projection is based on that. Of course, because it is projected, I typically like to be, I'll count it when the actual report comes in. Let me say it that way. If they are able to meet these results, though, it'll be extremely impressive. So that would be good to see. They would have grown in terms of revenue compared to 2021. So that's what we're looking at here. Again, what we'll have the opportunity to do is ask Ricardo about this, because what I'd like to understand is what would have led to the growth here, because what we're seeing here for one quarter would be about 140 million in revenue, right? So I'm very curious about that number, and I'd like to understand what would have led into that, because we do see where some of their divisions are not fully on stream as yet. So I'm curious to know, or hopefully understand, what would have been the makeup for this, right? But again, I'm sure they would have a pretty good idea at this point, since we're more than 2 months into the quarter and leading to the end of their financial year. Okay. All right, let's get back to the Excel. So that's their profit and loss. So let's take a look at their balance sheet now. I can pause here and take a few questions. Let me see if there's anything that's relevant to what I've spoken about so far. Just take that off the screen there. All right, so what we'll do, we'll take all the e-invest questions for the end. So if you have any questions or concern there, I can give you some updates at the end of the video. Yes, the IPO is now available on JMMB Moneyline. So we'll speak about that at the end, guys. I think that's the best way to do it. All right, so Peter is saying, based on what I saw, they're doing well with them financials. Why try to go back and compete with people? Well, I mean, every company has competition, right? So let me read it again. Let me try and bring on Chike one more time. Chike?
Don't you hear me?
I'm hearing you. Your video is very blurry though. But as I was saying to you, maybe you should try and turn off your video. Maybe that will help your bandwidth. And check to see if you have anything downloading in the background. Maybe that might help.
Not that I'm aware of, but I'm not sure what is happening today. So
okay. Well, you sound fine. And guys, let me know if you're able to hear Chike clearly. You sound fine to me there, so I think that's fine. All right.
Okay. All right. Cool.
All right. So Peter is saying, based on what he sees them doing with their financials, why I try and go back on. Okay, I don't think that's something I need to comment on. Bantu is saying I promised a video in terms of the terms used in financial statements. Yes, I have not forgotten about that. We're actually trying to produce that. Well, create the details for that content now. It will be released soon. All right. All right. Perfect. I'm not seeing any other questions. All right. So Chike, we just looked at the revenues. I don't know if you have anything that you wanted to add to that before we move on. I don't know if you heard everything that I would have mentioned.
I heard some of it, but you're looking at it from the numbers side. Well, bring up the. No, did you bring up the charts?
The charts from the prospectus.
From the prospectus, yeah.
No, wait. You want us to dig into those 1 sec? I didn't look at the revenue charts. So,
yeah, so those are the ones that we definitely want to look at. It shows very massive improvement for their revenues.
All right. So
I've gone again.
Yeah, man, you're going in and out. So try it one more time. If we're not having any luck, then you may not be able to join us for this one. I don't want to go through this.
Yeah.
I try again.
Yes, I'm asking, was there a gross margin chart and an operating margin chart?
Let's see. There is a gross profit chart.
Right. So
and
the net profit. So I'm hoping I can get to show everybody that, but this was what I was focused on. Not necessarily their gross profit, but in terms of their net profit and so forth. Specifically their gross profit margins and their operating profit margins. They have basically blown that out the water every single year. Their gross profit margins is well above 80%. And their net profit and their operating margins is every single year. I generally have no idea how they're doing it, but kudos to Ricardo and team, because their operating margins every single year have been above 100%, pretty much. Well, based on the figures that they provided in that prospectus to do the operating margin calculation.
Don't you think that's one of the benefits of having a technology company? Because what happens is that you're able to scale and not have the expenses rise at the same rate.
Well, you see, you're making a statement that is in possibly in general and would apply to all markets, but in this market particularly and in companies in general, to see a company run operating profit margins for the last from 2017 forward above 100%, right? As I'm above 130% every year is pretty impressive. And even in their even in their 9 month 2022, it's currently running above 25% for their operating margins. That ticked all of the boxes that I have there as good stuff. So you know me with that one. Additionally to things like their net margins, and net margins are for the last 2 years we have an average of 32%, right? And their return on equity is an average of 117%. Like that's just crazy.
Yeah.
Right? Return on assets.
One sec, Chike. One sec. Persons are saying they're not able to hear you. Have you tried to reset your modem? I think that might help, you know.
Yeah, I did that. Well, let me try that one. I'll do that one last time and then I'll come back in.
All right, cool. Thanks, man.
Yeah.
All right, guys, apologies for that. Yeah, it's definitely in and out for me as well. All right, so what Chike was saying pretty much is that he liked the fact how the operating profit was progressing. Now they don't have a chart specifically for the operating profit, but he's saying the fact that they were able to maintain such good gross margins. That's what we're seeing here, the gross profit. And then next, the operating profit, and I'll just point to that here. And you can see how it was for 2020 and 2021. He was just saying, that's good to see. All right, so that's pretty much what he was saying. That is something that, you definitely see the stark difference for 2020, 2021. Those are definitely good to see. I wish these graphs were a little bit higher quality. They seem a little bit blurry here, so I wouldn't want to zoom in even more. But you can see clearly from the bars here that they were able to do significantly well for the last 2 years. And based on their projections, we would have seen some projections as well. Let me look for those. They had them somewhere here. Yes, so they would have shared projections for the next 3 years. Now, again, you want to look at these as projections. Anything can happen to impact this. But these, I guess, would be based on how they expect the company to grow based on their own plans and maybe some of the business they're expecting to have. So they would have outlined clearly the divisions that they expect to pursue. And further in the prospectus, they would have outlined all of the divisions and what the expected revenue is for 2023. I haven't done an addition for all of them yet, but I guess the expectation is that it should total this number. And then I guess what they would have done is just done a projection for the next 2 to 3 years based on how they're expecting to do for next year, right? So it's safe to say that they're expecting to be able to maintain the same gross profit margins are similar. We see 80% here, 73%, and the net income margin pretty much between the ranges of 27 to 32%. So we look into the ratios here. Their margins would have been right now for the last 2 years at least. Well, let's look at net profit margin, 39% and 25%. So I guess what they're doing is taking it on a little bit on the lower end. So if you look back here, you're seeing 32, 27, and 28. And what they would have done for the last 2 years would have been 39 and 25%. Now, if you try to average out the years, because you had negative for 2 of them, that's not going, I don't think that would necessarily make sense here. If you average these 2, that's 14%. That's about 32% there. And that's pretty much where about, I believe, would be ending for 2022. I didn't do the calculation, but I guess I can just do it quickly here. I just do the net profit margin calculation here. Just do a quick net profit margin calculation. So 93, 334, 405, 548. That's about 28%, right? So they're keeping it within the same range. So if they're able to maintain the same margins, then it's reasonable to see how they would come up to this number here. Hopefully you're understanding what I'm saying, right? And what we'll be able to see in a few months is how well those projections are in comparison to what the actuals will be. All right, hopefully that all makes sense. So let's talk about the balance sheet now. All right, so because based on the type of company, you're not going to see any inventory. Well, you may see inventory soon because, of course, the classroom in a box is a physical item, but they did give some insight into that as well. It's a partnership with a company outside of Jamaica, so they share ownership of it, or at least they have the rights to use it, and they focus on just installing the content and having that available for students or the customers who will use it, right? Where you're mostly going to see intangible assets for a company like this, right? So that's sitting at 139 million at the end of 2021, and they're projecting that number to be, well, for the 9 months ending for 2022, it's at 189 million. And again, it's intangible. It's not something physical, but it is an asset to them because it has value. Property, plant, and equipment. You're going to see this number fairly low in terms of value. So it's grown from 4.1 to 5.6. And they would have, let's see where they're projecting that. Did they give a projection for the balance sheet? No, they didn't, right? Which is okay, right? In terms of the next part that I want to focus on here is their trade and receivables. That definitely something I wanted to look into. So for 2021, they're showing here, that's this column here. We're seeing 114 million, right? So I want to go to the notes here and see if there's anything that we can say to give some commentary on the receivables, just to understand maybe if they have provisions for losses, if they have anything that they want to say about it. Trade and other receivables. Is this it here? I think this is it, right? 12 months ending 2021. Okay. So it just says trade receivables here, prepayments, withholding tax. All right, this doesn't tell us anything. So let me search a little bit further. I'm looking for just some insight as to what either they're commenting on the risk that maybe they're with their receivables or anything else. All right, Chief, you back?
Depends on if you can hear me.
Yes, much better, much better, much better.
To restarted everything.
Finally pay your internet bill.
Agreed. Restart the router, restart the modem, restart everything. It's
good. Yeah, man, you sound much better. I think everybody can hear you a lot clearer now. I'm trying to see if there's any commentary that was given on the receivables. Did they say anything about any potential risk there?
You'd have to look in the notes. So you were on the notes just now.
Yeah, that's what I'm doing. That's what I'm trying to find. So I know you guys can't see anything at this high level, but once I see something that's worth reading, I'll zoom in.
So it was note 9.
Note 9. All right, so yeah.
So note 9 really is just a breakdown of the different receivables that are there.
It doesn't give us any details.
But it does give some detail with respect to what their trade receivables are now and their expected credit losses.
Yeah, this line
it's very small in comparison to those trade receivables. So I'm wondering, I don't see anything that would further explain what's their holding period for how they do their payments, etc. So but the fact that the expected credit losses are that low in terms of it's only $809,000 that has been allocated it for the current 9-month period versus the expected receivables that are up in the hundreds of millions. It looks minuscule to me. But
Yeah, so what I'd want to know, of course, the question that I would have for Ricardo tomorrow is how is this made up? The expectation, for example, if it is government customer, government, you have to understand that some credit terms are expected. Some persons see government as risky in terms of payment, others see government reliable in terms of payment. So it really depends here. I mean, I think the government in general has kind of tried to as best as possible honor their obligations. So based on these, if it's mostly government in terms of receivable, then it's just really a matter of time. If it's then I think we should be okay as well. I see David backstage. David,
you don't have to guess it either, and David coming in can answer, but it's right there as to the makeup of the revenue. So what was it? Go to that chart, go up to the chart that is on
the one that
that will tell you exactly where the revenue is coming from. So it's on page on page 67. Right, so page 67, that is it. And it's gonna basically so that you already see that's 34% basically for education management, right?
But
so if the government
but hold on, Cheeky, you can't say 34% of the receivables is coming from this.
No, I'm not saying that. We're just looking at the revenue generated of itself, and then I'm correlating where does the government fall in this pie in terms of which part of the pie do they take up. Right, so if they and I don't remember, that's why I'm saying it which part, because I don't remember which part of the pie they take up. If they fall in the 34%, and it's not correlation to the receivables, what is clear is if you look on the financial summary breakdown for the years from 2017, the receivables jumped from what was in the single millions, right? And then by 2020, there's an astronomical jump from $8 million to $114 million.
Exactly.
Right? In lockstep, not necessarily in lockstep. Focusing on that, it means that there is money to be received. A lot of it, right? So the question is to be asked: what's the time period for payment? How long do you expect to do so, and how long before they write it off as a loss? But again, in the same financials there, you can see that the ECL that is given for the 9 well, that's the 9-month period, right?
Yeah. So I agree with you there. The only thing that I want to know here is, so for example, is it the standard thing where you're listing the receivables, for example, if it's 90 days or less? If it's 90 days or less, that's no problem to me. If it is, let's say, that's the amount that maybe some of it is 120, some of it is 150. As you know from receivables, the longer it is outstanding, the higher the risk of you not being able to
pay
money.
Right.
But again, it all depends on the makeups, right? So we don't want to speculate, because we could be trying to put ideas into people's minds. That's not what we're trying to do. We're just talking about it just as we would for any other company. All right, so David, we're gonna bring on David now. 1 second. David, how you doing, man?
The seat, man. I plan to get I plan to take a short period of time to rest, and the teeth just there's a little bit more.
Yeah, man. Agreed. My AC has not been turned off all evening, which is not good for me. But yeah, so I know you were saying something about the receivables on Khalila's show last night. You want to add anything here? We're talking about the receivables.
No, so Chiki was correct referencing the government, because I recall looking back through LASCO distributors specifically, their financials kind of highlight what Chiki is pointing out. So as you realized, once the receivables balance the provision is flat, that kind of tells you all you need to know. So that 854,000 you're probably seeing is just for some of the customers, but the fact that it doesn't really increase materially tells you that, majority of that is attributable to governments, which, don't tend to have ECL provisions put against them, in essence.
Yeah, yeah. I mean, for me, I like to, if something is not explicitly said, I want details. So that's just always my stance, right?
No, but what we could do
It
is,
can be, who
did we
knows?
check
Oh,
the
actually, sorry. Let me jump in. It is specifically stated actually on page 70 that
Perfect.
the increase in receivables is mainly represented by amounts due from governments, including the government of Jamaica, the government of St. Kitts and Nevis, the government of the Commonwealth of the Bahamas. The,
Okay, here
so,
we go. Right here, right?
yep.
Perfect. All right, so there you go. That explains. I didn't finish reading all of it, so thank you for that. The increase in receipt was mainly because I was just gonna read through the notes at the end after we finished looking at the numbers. Perfect. All right, so
what I was saying was the next time we could just check I've learned that you can also check the liquidity risk in the auditor's notes. That's another thing we could
okay,
always do.
all right.
Oh, I didn't see that. But yeah, okay.
I saw liquidity risk somewhere. Hold on. Well, right here.
Give me a
You'd have,
second.
you'd have to bring the screen up a bit bigger, but okay.
Just give me a second to connect. But liquidity risk rate really should no. I wouldn't say that part, but oh yeah, I think that's it.
Yeah, man. Thing is,
No,
I mean,
this liquidity risk is talking
that's some
about
liabilities. That's not talking about
that's right. That is about
that's
payables. That's about payables and so forth.
no. Cause
ah,
the thing is,
sorry, sorry.
just give me a second. Is it credit risk? I can scroll back up a little more.
Yeah, credit risk is around here.
You can scroll back up there and see if there's
Receivables.
anything above that.
Scroll up again.
Yeah, see if there's anything above that. Oh, the table should be there, but I'll look for it in a second. But
I mean,
it's usually within
this is
credit or liquidity.
this is the kind of thing I don't mind asking Ricardo to speak on tomorrow. So yeah, we'd have to spend too much
No,
time
no,
trying.
no, no, no. The reason why I mentioned looking at that particular area is because on the credit liquidity risk actually tells the duration of the receivables outstanding. That's the thing about it.
Okay, okay. Well, yeah, we
Which is
definitely.
what we're looking for. That's exactly what we're looking for. I was saying that. That's what I was
Yeah.
saying.
All right, hold on, hold on. Let me try to find it then.
Give me
A
a
fast
second.
reader here.
I'm actually looking through. So
Yeah, man. Look through as well, and just let me know if you see anything.
so for the 9 months, I'm not seeing a breakdown like that in terms of the audited financials. Them was audited,
Are you want
but
to share? Let me know if you find it.
no, I'm just looking back straight at the 2021 numbers.
Okay.
Oh, so I just looked through a while ago, and there's no breakdown like that.
Okay. Okay. So
Yeah.
I
So we
don't
just have
see
to wait.
I don't see anything that would speak to because I looked at financial risk management, spoke about all of them at a high level. Here it speaks about creditless trade receivables. The company uses a provision matrix to measure expected credit losses of trade receivables. The provision
Right.
matrix is based on its historical observed default rates over the expected life of the trade receivables and is adjusted for forward-looking estimates. That yeah, that doesn't that's standard to me in terms of what I'm seeing.
Yeah,
So
just
I think I would just I would just ask about it to but they did comment on it there on page 70 saying it's
yes,
more of the government, so we just have to it's just something. So for example, if they end the 2022 year with that figure still there or growing, then we can maybe get an idea as to how much they were able to bring in or bring down that balance based on the 9 months. But with government, sometimes it's just a matter of time, right? POs need to be clear. There's a process that you have to go through. So I mean, that's, as I said, that's relatively standard.
We can ask, and you can ask him tomorrow. Indeed, what is the, on average, what is their payment period that is for that they've assigned each to the two. If he's able to tell us, that is, because who knows, may or may not be able.
So the reason why we're spending time here, guys, in case you want to know, when we get to the cash flow statement, we'll be talking about, this really comes into play because, of course, when you generate revenue, if you're not able to now have that cash, you need to find some way to finance the things that you do. So you either need to borrow or you need to raise cash some way, right? So receivables are important to look at because the cash has to come from somewhere. So that's why we're spending time talking about it, and that's why we're doing financial analysis, right? So that's why we're spending time on it here now, because we can. that's how it works, right? So cash and cash balances.
And also persons must, I was saying, and persons must also know that it also impacts the profit line or the net income line. So what you can see in a profit and loss is great looking net income, net profit. Cash-based net profit versus income that is coming in from IOU. You have to look on that receivables line.
Yeah, and I know that that's one of the things that you'll always look at, and we will see. That's one of the things we can anticipate because they are getting IPO money now, so that will be reflected. And I know Chike very well. He's gonna say, remove the IPO money and look at the business after that money has been received and see what it's showing you. Right, that's the very thing that he's gonna do. So yeah, cash and cash balances, right? This kind of speaks to exactly what we're speaking about before. Their cash would have grown from 2019 to 2020, but relative to revenues, right? So in 2019, 9.5 million in cash, 2020, 24 million. So just by looking at this alone, you'd say it would have grown, but in comparison to revenues. So again, that kind of probably says to me that, I mean, again, I don't necessarily want to speculate here. So tell me if I'm...
You don't want to speculate. There's no speculation. More importantly, actually, if you're looking at the cash and cash balances, you want to equate that now back to the cash flow statement of itself, right? And see if the cash that was being injected was actually from operations or it's coming in from financing in terms of if they were taking
that we can answer, right? So let's go there.
It's right there. So what I was impressed, well, what I won't say impressed, I was comfortable with is that at least for their operations for the last 2 years, they have been generating cash out of their own operations, right? Yes, which is really good for the company based on the fact of when you get down to the ratios in terms of debt that they've undertaken was really high. In my opinion, it was really high. So they've actually been doing pretty decent to move that from a negative to a positive for the last 2 years. But more importantly, people must understand that all of this comes together to basically give you that final cash and cash balances amount.
Yes.
Now, that's going down the line. Right, so going down the line, you have a positive there. Then inside of the cash flow from investing activities, it was negative. Now don't go too fast, go back, right? So notice that's two negative lines. You're going to take that away from the top, and then you go down to the financing line of itself. So the net cash from financing, you notice that they got some injection of money, and you notice they've been getting injections of money every single year, but it's gonna be stated that basically this company needs to be, in order to generate, they need to basically be getting capital to keep growing, etc. Now the thing about this for me with respect to the IPO of why even as I always say, remove the IPO money and we see where it's at. But still, here's the deal. Here's now a company that's going to be coming to get the IPO money. That is going to free up a lot for them. Secondly, they're going to be on the market for the next 10 years. So sorry, they're going to be on a junior market with the next 10 years reprieve, in which the first 5 years is no taxation, and then the second 5 years is at what, 15% taxation of
We'll
itself.
clarify that. I think it's 50%, then 25%.
Right. So that being said and done, they're gonna have a nice little reprieve, because when you go to the revenue line, when you go up to the revenue section, and you look on the taxation line just before you get to net profit, right? You see how much they've been booking. That's 4.6 million, 4.6 million, 2.2 million. Right? Yeah. So all of that is going to get removed. And more so, everybody must understand, the more revenue you generate, and then when you take out all of the other lines, such as the finance costs, the administration and general expenses, the more earnings before tax that they have accumulated is the more that they're supposed to pay in terms of that taxation, right? They no longer have it. So if they generate with the projection that they've given, if we look back on the projection of itself, they're projected to generate much more than they're currently doing. That means that would have been subject to tax. So that tax is gone, pretty much. There's no more tax that they have to pay. So that's pretty good. That's a pretty good wind in their tailwind for them. That is gonna push them, and that should push them along very nicely.
Yeah. So it helps them overall in their cash position, is what we're saying.
Indeed.
So what you should see is this cash and bank balance.
You're right. It should definitely be growing. It should be growing nice and steadily every single year. And I mean, I look forward to that, because, to be very honest, so this is yours. Give me a second. I just wanna let me try and see if I can share mine.
No problem.
I'm gonna have some fun with everybody. Give me a moment.
You're going to scare all the newbies.
I'm about to scare all the newbies. So let's go, guys. You're going to be solidly scared. So this is my sheet, and this is what Jermaine was looking at. But what we're getting to is, let's get to the cash part of itself.
All right, Chike, zoom in a bit or click on where you're...
Wrong one. I'm sorry.
Yeah,
sorry. No, don't worry. You guys should see it now, right?
Yeah, man, we're seeing it. We're just not sure where our attention
Okay,
should
good.
be.
Yeah, man. Come in. 1 second. All right. So here's our taxation line, right? So the analysts like to look on things like earnings before interest, taxation, and depreciation and amortization. Notice that this is gonna go up nicely, or should continue to go up nicely. When you remove the taxation line, or should I say the earnings before tax, this is pretty much where everything is going to stop. So until we add in like things like depreciation, if that even happens, how often that happens, I should say, this is basically what you're looking at. There's no longer any tax. So this part of the line is where things are going to be mostly focused on going forward for the next 5 years. Now look at this jump. This jump is really nice, from 199 to 358, right? And that's because, as I said earlier when I was coming in choppy, this company books a lot of revenue, but it books even more operating profit, which I find amazing, because it's actually the first company that I've analyzed like this, that I've seen this inverse situation. It's normally that you have really good revenue and then really good gross margins or gross income, but then you have like a low amount. Let me make bold. I'm going to show you shortly. So the gross income is here, but then when you get to the operating income, it's even higher. And what that tells you is that they're really doing well with respect to their operating expenses, and more importantly, they're booking something down the line that is really looking good for that. So I just found that phenomenal, because again, when I looked on their gross margins and their operating margins, this is just clearly bonkers to me. Like I smile when I see something like this. So yeah.
Anything you want to add to that, David? We're talking about their growth in cash and cash balances, how we kind of expect that to grow. So we know that they're going to be getting some funds in from the IPO. So we'll see an increase in cash. One of the things, as I said, Chike likes to do is remove the IPO money and see how the company is been able to grow without that. But I don't know if you have anything to add to that mix.
No, I was trying to look back a while ago at Chike's spreadsheet. I was trying to figure out how did he get that figure in terms of operating income greater than revenue.
Share it again, Chike, let's see.
No, hold on a second.
Yeah, I wouldn't try and figure out Chike.
No. He actually is right, because I'm looking at, so hold on a second. One moment.
Yeah,
I actually might have. No, that's not the right one.
I'm sure that your data is correct, sir. I don't want any.
The data isn't the problem. It's probably some mistake as E transpose going down the table.
Transpose going down the table, indeed.
I don't want any messages after the video, you know.
You won't get messages, indeed. Hold on a second. Let me just double check something.
Just clear it up right now. Please show. Just fix whatever was not correct, and let's show the correct thing.
Okay. Yeah, I did. Give me a second. Hold on. It's me.
Sure,
Give me a second.
All right. So really,
because David is right.
Yeah. I was gonna say to the guys here that I hope everybody is able to follow and understand. We do have a video where we go through fundamental analysis, so I can link that video. It's something that it's in our link tree. It's one of the 3 videos that we recommend you watch before you start investing, just in case there's anything here that we're saying that you're not able to follow. But this format that we use is standard when we do our earnings review, when we do financial reviews, when we do quarterly review. Same way we talk about it. So if you're not able to follow now, just ask questions and we'll try to answer them as best as we can. Okay.
I did it over. I profusely apologize. Wrong cell, wrong everything for that.
That's it. Because the thing is, all I did was those numbers will add up in my head. I read the prospectus, so that is why I know that's something.
You know exactly. Wrong. It's still good though. It's still good. So let me make it bigger.
Share again. And so the thing is, I had looked away, so I didn't see everything.
So here we are again. It's still high. Right. So correct it. Sorry, guys. I apologize.
Thank you, sir.
So please let us correct that. It's still high with 30%, 46%, etc. So the gross margin is not the wrong one. It was the operating margin that I had. Which still brings. Let's go back up and do it over again. This is their gross income. This is their operating of itself. So after everything comes out with respect to the expenses, you drop down to 82, 64. This is for the last 2 years, basically, that were there. And then you, from there, get your gross and operating margins, which for me, as I said, is still pretty good, because my threshold is 15%, pretty much, that I want my operating margin to be above.
For what company though? What type of company?
Any company. You see, that's the thing. I always say I do my expectations. So any company that I set in is set against these thresholds, and it's rigid. I understand the argument. The argument is always, oh, the industry is this and so forth. But I've always argued, if a company can't stand on its own 2 feet by itself with respect to my thresholds that are there already, then I now have to scrutinize it even more. And I am actually pleased to see that they, on its own accord, without any changes to my thresholds, you just throw them in, and this is what I come out with. I also for the 9-month period as well, they come out pretty nice. Now this was right, so that's why I said the cells were mixed up, because it was really high there, and I should have caught this already before I did that. So the operating margin for the 9 months 2022 is 25% of itself. So look on this. Going forward, you're going to have a company that is basically doing, not to say that it's going to dictate the future, because past results does not dictate future. Yep. But this company on average, right, does a gross margin for the last number of years. That's an average of 81%. Right, 81.6%. You can't see it, it's way down at the bottom, but it's 81.6%. and they do an operating margin on average of 10.59, and that's inclusive of the two bad negative years that happened in 2017 and 2019. But if you don't put them in and you only use the last 2 years, which some analysts like to do, you still end up with a 38% operating margin. That's pretty good, because that means that, for me personally, I already know that when I see stuff like this, I mean, I already can tell this company is handling its expenses. It's handling these lines down here, operating expenses, is handling any other things that fall into upper. So all of those selling, general and administration expenses, that big breakdown that is in the prospectus that shows you salaries, contracts, payments, and anything like that. Yeah, it automatically tells me the fact that as soon as I get down to here and it's above 15%, it means they're doing what I expect them to do, that what I would want them to do. And in the 9-month period, they're doing it as well too. So as a matter of fact, I apologize, it's not even 15% because 9 is highlighted in blue. So that means that it actually is lower. Let's see, I'm just going to check it. It's 5%. Now that's interesting. So it's 5% for my operating margin that I wanted it to be above. I don't think that is as rigid as most people might think, actually. So a 5% operating margin, and they're doing 46, 30, 25, etc. Yeah. So bodes well for them. Another big part that I definitely wanted to look at, though, with respect to
one step before you go to that, you have the cash flow statements entered, right? Because we wanted to do the cash flow analysis next, so you can just go right into that after you finish, right?
Right. So the last part too is, or the next part is the most important part. How we could possibly, as long-term investors, get paid. Those who read the prospectus have seen that is 25% of the net profit attributed to shareholders that they plan to do or give later on down the line when they finally pay dividends. And if they keep on the same trajectory that they're on right about now with respect to their ROE, which is pretty good, we're going to be in good standing with them in terms of that. So really and truly, it looks good. I mean, I liked it. Once I plugged it in and everything started going, as I said, those who have seen us or seen me know that I tell you I go straight forward. If it turns up red, it's cautionary. It's something that it's not a red flag, but it's something I'm going to dig deep in to see if it's over time it has been happening. But if it's yellow, and especially if it's blue, that's what I want to see. Last 2 years, a lot of the right indicators are blue for me. Net margins, return on equity, return on assets, operating margin, gross profit margin, their free cash flow of itself as well. So that's very important. You guys know that about me. And in that vein, moving right into the cash flow section of the company, we did highlight already their cash flow from operating activities. Of course, everybody has to do capital expenditure in terms of property, plant, and equipment, and so forth. That's very low. I'm guessing we might see something more from them later on. Who knows?
Yeah, I figured we'll see some more investments. I think in the classroom, in a box, some expenditure there.
Right.
I'm not sure if they plan to expand in terms of. I mean, I think they said all of their employees are remote, if I'm not mistaken.
Correct.
Yeah.
So nothing in terms of investment, in terms of infrastructure there.
So, David, what I really want to see, though, and I'm looking keenly for, because prospectus it's not there, and that's expected. They're not going to show that in a summary. But these areas, interest income and interest expense, I am keen to see what going forward in their financial report starting, what this looks like. Why is that so? Because for me, that dictates how their EBITDA is, and I made a typo. That dictates how their EBITDA is impacted by that expense. So not just EBITDA alone, but also they have their interest expense ratio, which basically I will automatically get calculated when that drops in, right? Because I want to be able to see how often they're able to, or how easily they're able to pay off that debt, how many times it's there. and I can't get that until this column starts or this information starts to properly fill up. No, actually, funnily enough, in their 9 months, they didn't provide the interest income because I guess they don't have any, but they have interest expense, right? And as such, I did actually get a number for that. So it's kind of negative. It's negative right now, and it needs to, I think, be calculation. So, but for the cash flow, I mean, Jermaine, you went through that already. We already saw where that stands. The last 2 years of cash flow, pretty good, but that is pretty good based on the fact that cash flow that was given, they got money in 2021.
They have gotten 75 million.
Right.
I believe they got, I don't know if they got more because I know that
No, they didn't get, well, I don't know if they got more now, but the year before, there was not an investment amount that was made. See, they held that back. So persons know that when you see a positive number, in one look, if you see a positive number from cash flow from investing, you should ask, what is the company planning to buy, or what is the company doing this money, right? In terms of what they might have planned to do, because that impacts the final line that is there. So, I mean, I like this though.
So,
David.
Chike,
Yeah.
your capex right there, it looks a little bit understated. I remember that one of the ones main capital expenditure item would be its intangible assets, which would be its I'm gonna look back and tell you what I was specifically speaking about. What intangible?
We had that. I know exactly what you're going on. So I kept the capex. So the capex is actually the first and very simple calculation. It's not the actual more CFI related one that you put in the intangibles as well. It's basically just property, plant, and equipment from the.
No, but Chike, remember, they don't do much in terms of actual PPE. They're not a company that's building out a physical front with different locations. Their biggest asset is their intangible assets, which is to. I remember Ricardo spent $6 million recently. I think Ricardo said they spent $6 million on R&D for the company. You understand?
Right.
So, and that's mainly go heavily into intellectual property because when you look at the company's actual, so at the end of May, their PPE GK was $4.14 million, right?
Mm-hmm.
While their intangible assets was $139.82 million.
Yeah, which is what we're seeing right here. So
Sorry, $189.8 million. Apologies. But you get them paid still?
Yes.
So I think that you kind of need to go back to some of those figures because
which is right.
Remember that one-on-one is specifically not a company, which is in this case, by the intangibles like a financial company, which by different case, or probably like a manufacturing company. Understand? But those other companies, they're bad intangibles, for probably like branding purposes or something else. But in the case of one-on-one, their assets is not necessarily physical in that sense. It's a platform that they built up and continue to build on, which is their key asset. So let's say a baking company where their main PPE would be the factory or factories. For one-on-one, it's really the technology that they and the other intellectual property assets that they are spending money on right now.
All right. So I'll make the adjustment to that one. So you're saying just that I need to do the inclusion of the acquisition of intangibles.
Correct.
To get it. Okay.
No, because look at the GK. Remember, although you're seeing, for example, $20 million in cash from operations, a majority of the funds went straight back into investment in intangibles. Like the spend on PPE is so inconsequential compared to the intangible assets. So you have to put it into real context. You understand? Because the reality is, when you take out the quote-unquote long-term loans and the convertible notes, for example, the cash flow didn't make up for it. But you get it, I'm showing you though still. The company continuing to take its capital to reinvest into its business. You understand? Which is something you like to see with any company. But in the case of one-on-one, you want to see them spending more of their actual operating cash flow back into the intangible assets because that's how they're able to actually get more customers and generate more revenue. So that's critical for business like them compared to another company, which is, buying property, which, really and truly has a finite life because the IP is not being appreciated.
Okay. I'm gonna add it and I'm gonna update it for sure and see where it comes out because I mean it's still gonna come out. Yeah, it's gonna change definitely at that point in time here. I'm hoping that, but it's still gonna come out with a positive. It should still come out as a positive based on where their cash closed at. So let's see what happens when I get that.
Okay. All right. So what I wanted to do is go into just the key ratios very quickly. So I shared some ratios. Let me go back to sharing my screen here. So Delton had a question. Delton, I'll share the contract soon. I just wanted to speak about, so we spoke about, I don't think we need to touch on these two. Just wanted to talk about the leverage, right? This was the part I wanted to focus on. Just their debt to equity, debt to assets, etc. I think we spoke about profitability somewhat when we were going through revenues. So I don't think I'd want us to focus on that because what I'm trying to do is just get to I want to be able to go through the notes as well. So hopefully we have a chance to do that and still keep the video within a certain range. I don't want us to exceed more than 2 hours for this video.
Definitely. No.
All right. So what we see in terms of their debt to equity would have gone from
negative
0.98 to 1.19. Let me actually see if I can zoom in there, or let me just take us off screen so we can see that better. And debt to assets, we're seeing 1.26 and now currently at 0.37 as at the last financial year. And debt to EBITDA is started at -4, is now at 1.44. So I wanted to hear you guys' thoughts on that.
Well, for me as it stands right there, the debt to equity is coming down, so that's a positive. You put that on a chart, that's actually pretty good in that it's coming down. It went from a negative to a positive, and that basically just shows because they got money, they had to take on additional debt. So, but it bodes well that it's coming down. It's at 1.19 as at the financial year for 2021, versus a 1.48. To shave something like that off, that's basically what 17.17. Am I right? Or 0.11? My math is bad when it comes to trying to do this out of my head. But yeah, what are we looking at there? No, 0.2 from 1.48 to 1.19. Right.
Yeah.
That's pretty good to do that, to basically bring that down. So on a chart, on a trend graph, that's
for persons to understand debt to equity, that number going down is good.
Going to negative though is not something you want, because that means that you have negative equity or no equity. So it still needs to be a positive number, in my opinion. But it cannot also be very high, so you want to keep it. So for me personally, I share the threshold that I use for me is, with respect to this, is 0.5. So it needs to stay below 0.5, at or below 0.5. And once that's good, then we're good. So pretty much where they are at right now, they're basically 1.1x times my threshold, basically, in debt to equity, and coming down. So let's see what happens as they go forward.
Yeah,
Also, on the same
I think based on the fact that they were so well, we saw them heading higher in the negative, well, lower in terms of that number for the last 3 years, and then they would have taken a shift in 2020.
right.
So we really, I guess, would want some more periods to see to kind of watch that. It is, as Chike said, trending in the right direction. So that's what we'd want to see. So we do want to see a positive number, but we do also want to see a low number because it's pretty much giving us an understanding to which the company is able to cover their debt, right? So that's what we're looking at here.
Yeah. So what you also find as a really good, so looking on debt of itself, as you can see, so let's look on total debt to their equity. Show that for a second.
Total, you mean on the
So
balance sheet?
right, so you have total debt. You're not going to actually see total debt is
Yeah, we have liabilities.
Total debt is everything. Actually, it's all the liabilities. So it's total liabilities pretty
Total
much. So look on the
liabilities.
total liabilities line, right?
Mhm.
Go across. We already focused on financial year, right? And then you look on the equity line of itself, the total equity of itself that they have, right? So pretty much their debt has jumped over, but they're steadily growing it back. So I personally like to see where the equity is higher than debt, but I would immediately be debated against or argued against the fact that this is a company now entering into a new life cycle, a new growth cycle.
This information is gonna change with the next set of statements.
Right. So I take that point so easily. Once the trajectory keeps going, as I said, because I like how they do the operations, I believe they can bring that down. I believe that they're operating, they can get that.
The liabilities that were there would have been converted. Some of it is going to be converted to equity, right?
That too.
Yeah.
That too.
So I mean, just to give persons that understanding, that's what you saw. Those 108 million shares converted at 80 cents. That's going to be debt. That's gonna go to the equity side pretty much.
Right. Yeah. So yeah, so that's a good positive. So going back to the ratios again, we can move on from the leverage ones because those are the leverage ratios. And
you wanted to talk about these two, return on asset, return on equity.
So we spoke on those earlier on with the other graph, as you can see clearly. I liked both of those because they're high, and I have the same thing. A return on equity of 168% is bonkers. Because my return on equity threshold of itself that I had for them, that I have in general, in order to be for us, as a long-term investor, just needs to be over 15%.
So one of the things, though, Chike, me personally, when we have years that are outliers like this,
you ask what happened.
Yeah. So I mean, I would kind of look at
this was COVID.
Yeah. No, well, I wouldn't just say that. I'm just saying it's one-off, right? Remember the thing we speak about a lot, right? So if we have something that shows a major spike, you know, what happened the following year, what happened before, those kind of things. So
which immediately brings that into the context, because what happened the previous year and what happened the year after, while there is a dip, it still averages out way above 50% on ROE. And when you go across to the 9-month period, right, in terms of that.
I didn't do those calculations.
No, I had them. It's 30%. It's basically 31% 2021, and it's 28% for current 9-month 2022. That's still high, right? So they're more than likely going to still also run on above 50%, at or above 50% equity by the time they get to the end of the financial year. So again, bodes well if they keep doing what they do long term in terms of. So here's the thing for me. You see for the taxation period that they have, that no tax goes in the next 5 years,
yeah.
I expect I would, as a shareholder, a potential shareholder, I would be keen to see them make absolute use of that period. That 5 years is supposed to be all wind in the sails and nothing against their backs, right? They're on the market, they've got fresh cash, nice injection, no tax. Let's go. Cool. Let's see how you improve. And to be
Aggressive
very
growth,
honest, this is
5 years, right?
already right. I want to see aggressive growth, but the truth is, I'm also not going to fault them because this is already listed, right? Gross profit margins above 50% is not something that is normal for a company that is not listed, that is doing, and you rightly said it, it's a tech company, it's an educational tech company. Yes, that's a space, but still, they've been around from 2013, given, yes. And they're showing us from 2017. But these kind of margins rival some companies that are on the market for years,
Yeah, man,
not in the same
we won't go
space.
there. We won't go there. We won't go there. We won't go there.
No, we're not going there. I'm just giving the context that I like in terms of when you, as they come to the market. As a matter of fact, when they come to the market, if you're doing a full-on analysis, they could literally put pressure on the rest of the companies, right?
Yep.
In terms of
Again,
seeing this stuff.
those are the kind of comparisons we're gonna be expecting to see at some point. So what I want us to do now for like the last 30 minutes or so is so they have gone ahead and given us some projections, right? Some projections for 2023. So I wanted to talk about that. So we got so the dates for this was actually earlier in the prospectus. We saw it was September 2022. The one for professionals, Ricardo cleared that up for us in our Telegram group that it's 2023. So that's confirmed. So what they have is their divisions. They're projecting that 1-for-1 for students is gonna do US 660,000 for 2023. So it's expected to be launched this year, which is gonna be Q1 for their 2023 financial year. And then they're projecting that for the year it's gonna do 660,000 US. All right. The earning model, I really love that they showed us this here. So they have here a fee for each hour of tutoring booked and an annual membership fee from students who subscribe to their premium content, right? So that's the one for students. I believe this is their largest one. Let me actually do a quick check here. 660, that's their largest segment that they're betting on, right? One for students, and I believe that's their largest customer base as well. Next one for professionals, that's gonna be for trainers, and they're projecting here, for example, typical customer problem that they stated is a course on selling real estate in Jamaica from a certified trainer. It's interesting that they listed that because I think we spoke about that in the group, that's something that is actually lacking here, right? So this is a B2C service and a percentage of the cost for each course sold by a trainer. So think of a course platform, persons have their content, and as the platform host or provider, they get a percentage of whatever the course is sold for by the company, by the trainer, and they're projecting US 300,000 here. So if you just convert this to Jamaican, you'll get that breakdown, and they're saying the gross prospects for this is very high. But I am interested in, since it's gonna be launched in, this is their almost close, this is Q3 for them for next year. I want to know how far they are in terms of prospects. Have they signed any customers yet? Do they have just industries they're targeting, and then they're gonna try and build up that pipeline between now and March? I'd love to know where they are with this. The next part that they shared was one-on-one for teams. That's their learning management system here. This is a platform that allows them to conduct anti-money laundering training for their branches all across Jamaica, right? That's a typical customer problem. The earning model here is that they're going to license its software and off-the-shelf content for an annual fee, which is charged per employee using the system. The license fee will vary based on the number of employees in the organization, and they would have. This seems interesting. I think the US 35,000 here just kind of shows that maybe they don't have maybe as large a pipeline for this, but it's something that they plan to pursue. Maybe the targets for this become more aggressive in 2024 and 2025, because we do see that they have some aggressive targets for those years. So maybe this grows. Oh well, sorry, I was looking at 2021 actual, right? So this was last year. They're projecting to grow this from 35,000 to 225,000. So that's what 600% growth in that revenue stream for them. They're projecting. I'd love to know what 2022 looks like for this. That's one of the questions that I would have, right? Next, we have the content development. That one is projected to be in 2023, 450,000. For 2021, it was just 1%, so even lower than the one-on-one for teams. And then this one is projected to grow. This is what, 4, 16, 18 times, right? For 2023. And then I think this is the last two here. This is one-on-one white label. So they spoke about this.
That's the bulk of their earnings, actually.
This one?
Yeah.
Yeah, two. Well, these two seem to be. These two.
No, look at the actual 2021 actual and look at the percentage.
Yeah, man. These are the two I'm looking at here. I think these two are the largest amounts.
45%. It's right there. It's right there, Jermaine. It's right there below.
Yeah, man. I see it. I was checking the last page, right? So this one, the first one is an annual for licensing the software plus hosting and maintenance costs. And the one for government is monthly hosting and maintenance fees, as well as time spent on basis for engineers to customize. So, these two and the one on the final page, which made up 22%, that one was the one-on-one offline learning solutions. I believe this one is this a classroom in a box, David, the offline learning?
Correct.
Okay. So somebody was asking about this in the chat earlier. They wanted to explain it. So we'll do that now. So it's saying here, One-on-One has developed a product with their international partner to deliver learning to remote locations where there's little or no internet connectivity. There's a small device that can be deployed to schools or a community. So the idea is they're going to cache data to a device. So if you think of your smartphone and you just save the web pages, and now you're able to view and work with those web pages without an internet connection, right? So just like, for example, I see it working for data that is not going to be live, right? So for example, if you have content on let's say a school wants to do research and you have content on Wikipedia that you can cache, content on maybe even on YouTube that you may be able to cache because the videos might have been uploaded, but you won't be able to get access to live data, right? So that data is going to be cached to the device, and then you're going to be able to sell that to the schools, to communities, etc. Because the stat was shared that about 44% of Jamaica is still without internet access, right? So there's a good market for this. The next thing that I probably want us to look at quickly, I wanted us to go through some of the numbers that they have here in terms of their, let me find it, their average revenue per user. That's the one I wanted us to talk about here. Any thoughts on this, guys? David, Chike, average revenue per user?
Well, you expect that, remember what I want is that they're currently heavily in the business space, in the enterprise. So the fact that you're seeing $45 for the Excel for teams is reflective of, just the massive spend that the government puts out relative to the number of users that actually using the platform. And you realize that 101 for students, for example, and professionals is being rebuilt up right now. So
Yeah.
the ARPU is relatively low, but at the same time, it's not a bad thing because if the 101 generates out of the revenue in US dollars is a good hedge against depreciation and even just other levels of risk since they're spending so much in USD as well.
Yeah. I mean, again, what I like about this type of business, and this is one of the things that we speak about. This is a build once and then you can sell it many times kind of thing, right? So apart from the one-on-one for professionals, which would be like trainers, etc. This one where they haven't really built it out yet is going to be launched next year. For the rest, they're pretty much established lines of businesses. I'd love to know the segment. Let's go back to that revenue makeup that they had, that graph here. So this is showing you the makeup of the revenues based on what they're currently able to do. So you see one for professionals is 0% currently, unless I'm not reading that right. It's saying 0% here, which means it's one of them that though they've listed as on the average revenue per user, that's not generating anything for them currently. All right, let me do some quick math here. That's 47, 85. Oh, well, this math doesn't add up. Something is missing here. Is that correct? 34 and 22, that's 56. 56 and 25, that's 81, 85, 88. So there's something missing here. There's some data that's missing here in terms of percentage. So I don't know where the missing piece is. I don't know if the one for professionals actually should have a number, but it says 0 here. Let me try and zoom in for you guys to see it.
So I just added it up a while ago. The pie comes up to 88%.
Yeah. So I'm saying something is missing from the pie. So I'll ask about that tomorrow. The pie is not complete in terms of revenue generation because even the other is only saying 4%. Now, if the other was 17%, that covers the gap, or 88, so that'd be 12% missing. If the other was 16%, that would be fine. So we can ask about that. But this does say one for professionals, 0%. So that I would take to mean that they're not currently generating revenue from it because it hasn't been launched yet. That's the whole point of what I'm saying. The content development is only 1%. LMS for teams is only 2%. So there are lots of opportunities for growth there in terms of their contribution to the overall revenue. All right, that's pretty much what we're saying here. The EMIS is 34%. The offline learning solution is 22%. That's actually the classroom in a box. So I believe somebody mentioned that was 60 million already, or maybe I'm mixing up that number. But offline learning solution is generating some revenues for them already. And one for students, 25%. So I hope this information is something that they share in each annual report going forward, because I think this would be helpful to see how, as revenues grow, how these different areas grow as well.
Yeah, I did say that. That's it. For me, this would be really important to keep in the annual report going forward. That it will give a clear indication and show how revenue has changed.
Yeah.
So.
Yeah, man, agreed. All right. So lastly, what we can do is look at Outlook, right? Because they shared Outlook for some of the divisions. I want to find that. Yep, I think this is it, right? Okay. All right, so guys, please post your questions in the chat because we're going to get to the Q&A maybe in about 5 minutes. If you've been with us from the start, thank you. If you've joined during, just feel free to rewatch the start of the video after we end here. Please take a moment to like the video, guys. It really does help us out. Please, please, please. Thank you so much. All right, let's talk about future outlook. So that this spoke about this re-entry into the B2C market. So it's a market that they would have moved away from, but they're taking the opportunity to go back in. So the re-entry will see the company increasing its presence in the sub-industry through customer acquisition and customer retention. This product will allow the company to reduce its customer concentration risk. Very important. This is one of the risks that would impact this type of company. Based what this is, it's pretty much saying is they want to diversify their revenue streams. Right? Expansion of market. They will be expanding their reach into more Caribbean and Latin American markets. This will be done through partnering with region-wide enterprises. I'd love to hear some more on this, which countries in particular they're looking at. So I want to know which countries they're in now and which countries they're heading to. Growth in their content and certified courses with their primary and high school catalog. Improvement in terms of conversion, upsell, retention of paid customer learners. So this is speaking to is once you've had the customer, how you can upsell, right? You come in and you buy one item, can I, sell you something else? Pretty much. So currently across our projects which are sponsored, they're aiming to onboard and train a total of 30,000 students and professionals, which will allow them to retain and upsell a commercial product. This is interesting for me. So what this is saying to me, right? Currently across our projects which are sponsored, right? Sponsored means that either it's being paid for by the government. It's being subsidized somehow currently, right? So they're aiming to convert it after the sponsorship ends to ongoing business. Right, and they're speaking here about the things that will impact their projections. Again, as we said before, projections are just that, projections. And you have to wait to see because anything can happen to impact that. There are things that we cannot, plan for. Right, nobody planned for a pandemic. So risk is going to be retention of current contracts, and that was one of the things Delton was asking about earlier. So we look at the contracts. I think now would be a good time to look at those contracts. So let's find them. Let's find the material contracts. Sorry guys if you think I'm scrolling too fast. I'm a pretty fast reader, so I'm just trying to find it quickly and then I'll zoom in after I found it. They have a page where they show their material contracts. So I'm just trying to find it. Here we go. So they have their material contracts here. Some of them end this year. So for example, this one would have ended in June. I would have loved to see if,
they got a renewal.
Since this prospectus was in July, if this is not listed here. Now, I have personal experience with renewing government contracts. So I understand if this is probably just in a pending renewal state, okay? But this did expire June 10. Now, what we don't have is the size of the contract or the value of the contract. That would have given us some insight, or at least the percentage makeup of the contract to their overall contracts. But this one would have expired. This one is approaching expiration. They do have a 5-year contract with Flow here. Flow Foundation. So the foundation contracts, we don't know if that would have been some sort of temporary, thing to get through the pandemic. We don't know. This is something we can surely ask about tomorrow, but this ends this year. This was just set for 1 year at a fixed price. This one for August, Pan American Development Fund. Anything that says foundation and fund, to me, I'd be interested to know, because these things are funded through either money that is allocated to fulfill some sort of project. Projects have end dates. So I'd love to hear more about this. Is this going to be an ongoing thing, or this is something that is likely to come to an end. No, it doesn't mean that they won't acquire any new contracts, right? Because this is something that it's gonna be always changing in terms of the total makeup. Jam Pro, this ends in September. This was only for 6 months, so it could be a specific project or just some sort of a partnership for that period. So I would be here looking at all the ones that are more than 1 year. So Lasco, good partnership there. 3 years. That's
That's recently signed. Look at it. Look at the time when it was signed.
Yeah, man, I say that. Definitely a good sign. This one was signed just
last
month.
Years.
Last year, sorry. Yeah.
One for 4 years, one for 5 years. So those I'll be focusing on those by the time the annual report for 2022 comes out. Hopefully, again, this information is there so we can see which ones would have renewed.
Can you scroll down a bit? What's the next page? Because there's that. You know what I'd love to see? I guess we can also make a note to ask Ricardo going forward. If they can, so if FHI 360 is this specific to Jamaica? Because if it's not, if it includes a mix of both the Jamaican and the other Caribbean country contracts, I'd love to know which ones were which. Just to know.
Yeah. I mean, the thing is, I'm almost certain that for competitive advantage reasons, we probably won't get.
You don't want to.
It's Google. Just Google it. I just Googled it. So it's a non-profit based in North Carolina.
You see.
So from my experience, so I may be wrong. You do have the benefit, and this is so you have. No, I won't go there today. We don't have enough time. We don't have enough time. I'll ask her. Let's ask Ricardo about them tomorrow. Yeah. Anything else you guys wanted to touch on before I close out? Though I think we covered it.
We've got everything. Everything was touched for this.
Yeah,
for me.
I think so. All right, cool. So let's see if there are any questions. I would recommend that you guys go through and read the prospectus yourself. You definitely want to do that. You don't want to just listen to what we're saying. There are things that we are personally looking for as well as we try and make our own assessment, as you should. I said I would take a moment to talk about how to apply. That was addressed within the last 24 hours. So when we did the episode on Monday, I mentioned that it's only available on Sagicor E-Invest. That has since changed. So at the point of recording this video, it is currently available on Moneyline. We are anticipating, though not confirmed, that other platforms may be added as well. So if you have questions relating to how to apply on either platform, I'm hoping to touch on that tomorrow after the video that we'll have with Ricardo. So if you're interested in applying, you want to know how to apply, what I'll do at the end of my video with Ricardo or the latest Friday is just have a section of time just for us going through the application process. So look out for that, right? And as usual, if you have questions, ask in the Telegram group and we'll answer it as best as we can. All right, guys, any final thoughts about the company? Anything that you're looking forward to? I think it's safe to say based on the money that they're hoping to raise, they're likely to be oversubscribed because it's not a large raise. I think that one is obvious.
Remember, Jermaine, something to point out. You have to remember that although it says $358 million to be raised, you have to remember that the loan is being converted. You understand? Which is just the Sagicor and Panjam loans, and a convertible note, I should say. So it's really just $271 million that is really being sought as new capital. And the thing is,
which GK alone can clear up quite easily, right?
What?
Well, I'm saying those still. So
yeah, man, I do.
So the thing is, based on what we've seen in recent times, that shouldn't be a tall order for one-on-one, because...
Yeah, and I mean, the truth is, based on everything that we've looked at, it is an attractive company in terms of just what the numbers show, right? So...
We shouldn't be seeing it do not participate from many brokers.
Exactly. That's where I was going with it, right?
Definitely don't want to see that. But anyway, I don't think they could though.
What I was gonna point out. So remember, guys, Jane from Manager said they're going to publish their report on their website sooner rather than later.
Great. As soon
Check
as
the
they
same time
post it
JMB as well.
in the
Something
group, yeah.
from Proven. The broker's report should be coming up by next week or this week the latest, you know. So because it's open for quote unquote so long, it's published so long before its official opening date. The brokers are quote unquote have time to actually sit down and ruminate through the document, you know. So
Yeah,
we're
yeah.
looking
I
forward to
mean,
see what their price targets
we
are.
we don't have that luxury because we know we have a few other persons in the space. So if we don't do this review, somebody else would do it. So we try to go through everything in a weekend, but the brokers they have more time. They can go through it, prepare their detailed reports and send that out. So you should be seeing that over the next few days, as David said, sometime before the end of this week or early next week, well in time before the opening date. As we said, you want to treat the opening date like the closing date if it is that you're interested.
Oh no. Hold on a second. Yes, you can do so. But it has been clearly stated that it's not going to lock on the day that it opens.
No. So the reason why I say that,
No,
the reason
no,
why I
not
say that,
cheeky.
is that what from my experience,
Yes,
bro,
all of our experiences know that, and we know what is going on right now. Everybody is trying to sign up right now.
exactly. That's a perspective I'm talking about. Not necessarily FSC rules, but the fact that advisors are stretched, brokers are stretched, systems may not be working the way you expect. If you're planning to apply, don't wait until the day
That's
before
right.
or the opening date. Even if it doesn't close on the first day, which we're not expecting, you don't want to wait till that point. You want to do your assessment this week. You can wait for the broker reviews, read through those. I think if you want to make a decision, make one before Monday or Tuesday, so you'll have enough time to apply. If a few persons may wait until the opening day before they're doing their analysis, I'm saying I wouldn't do that, right? That's all I'm saying.
Yep.
So what I was also going to point out was that uh, you should also remember that if you're a JMB client, you can actually sell their shares on the morning of the offer and use the proceeds to apply.
Wait, run that again.
So all the persons quote unquote love say my last is then all the things about JMB. JMB has a lot of functions that people don't realize.
I
So
have no comment about that because you see
so
those same comments, David. I really wonder, in spite of the events we saw this week, how the same persons who are saying that stuff feel, right? But
it's still when the builder refuse becomes the cornerstone. We know, man. But I was going to point out, all right, so evidence for different offers. So JMB's platform, you know, allows you to use your trading balance, which should be the funds that are still in your account as yet, to actually
ah,
apply for an offer if you want.
okay.
So
So yeah, man. So I do have. Thankfully, I really want to thank JMB team. They actually gave me a demo account for Moneyline. Very very happy to get one, David. You know how long I've been trying to get one. So what I plan to do is go through the Sadcore eInvest platform. Hopefully, I'll get a demo account for that one as well. Go through Moneyline and show the application process. All right.
but yeah, that's something to point out because, you know, so instead of you having to rush, quote unquote, get the application in as of, you know, today, you have all the way to the opening date. So, you
Yeah.
know, that's one of the pros of JMB's platform at the moment. So unlike you having to be funding out a J Trader Pro, and wait till the funds actually settle to actually
Yeah.
apply.
Yeah. 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 I see
So,
what
so
you're saying. I see
so
what you're saying.
you have an extra 2 days above the rest of the market.
Yeah. Yeah. Yes. Good point. Good point. Good point. All right. All right, guys. I'm not seeing any questions. It's either our community members just know exactly everything that we're talking about, and they've gotten all their questions answered. I hope nobody was waiting for us to give a buy recommendation. We definitely can't do
That's not
that.
happening. That's
So,
not happening.
yep. All right, guys. Thank you so much for being here, Chike, David. Really, really appreciate it. I think we can close this one out here. I'm really excited about the interview with Ricardo tomorrow. So I'll ask you to send your questions directly to me on Telegram or DM us on any platform. We're going to be live 6:30 tomorrow with Ricardo. I'm not sure if any other members from the one-on-one team will join us, but I've extended invitations. If they are available and able to join us, they should. Jay, what's up, Jay?
We just said we're not doing it. Like literally. What I'm actually interested in is I'm wondering what dream Arville was talking about, because I have
no man. It was when I think when I mentioned you being able to cover the 300 odd million and you kind of jumped up. I think that's what he was talking about. Jay, all I'll say to this, I will say this. One of the first clues you look at for an IPO is once the basis of allotment has been announced, you want to watch that closely. That basis of allotment gives you an idea of the potential demand that you can expect when opening day comes. All right.
And of course, when all the other people come online. Well, actually, you would have gotten to that in truth. So the first part is general pool. More than likely, everybody gets closed, gets their allotment. Then you get the other pools that come online, and the bigger ones, who might want to decide to take some profit off the table.
Yeah, I mean, so profit taking is normal, because remember, on day one, once opening day comes, if nobody is selling, nobody can buy. So, I mean, you have to anticipate that at some point, maybe those existing shareholders will want to take some profit. Some of them have been holding for a number of years. Maybe they want to take something off, and based on the number of shares that we know are available, there are persons who may want more ownership of the company, because the expectation is, if it is you're not getting a large allocation for IPO, you're going to want to own more of the company. So you're going to be buying up, right? But you want to speak to your financial advisor to let you know what that personal strategy should be. If you don't have a financial advisor, you can reach out to us. We'll make some recommendations. We have a list of advisors posted in our Telegram group that you can speak to in case you need some assistance. Delton is asking if they have staff in Jamaica only or throughout the Caribbean. As far as I know, they're Jamaica. I didn't see any reference to anyone being outside the country, but they did mention that they're all remote. So does the potential exist for them to be outside of Jamaica? Probably, especially since they're looking to go region-wide. Maybe they'll have contacts in countries that they work with or something, like, I don't know. It's something that interesting could be for us to ask Ricardo tomorrow. You're welcome, Kefash. Thanks for watching. Hopefully you liked the video. Welcome as well then, Delton. Hopefully I was able to give you some help there, Jay. Hopefully you read between the lines of what I said and it was helpful. All right, cool. So let me just sign off, David and Chike. Thanks again, guys. I wanted to just give you some announcements here before I go. Upcoming investment class, September 3rd. The registration link is going to be available by the end of this week. We're just trying to finalize some of the details, so that will be out by the end of this week. We do have our coaching program, our group coaching program has been pushed to set the end of September. We're supposed to start in July. Based on our schedule, we thought it was best to push it back. So that's if you're interested in signing up, you can look out for that in September. Everything else, you can just look out for our weekly newsletter. We'll probably post something there if anything changes. Thank you guys so much. Hope to see you tomorrow. I'm getting some spam here today, so this is a good cue to leave. So I'll see you guys tomorrow. Really hope you enjoyed the video, and thank you for joining us. I'll see you in the next one.
Learning is the key to successful investing. And who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at L.E.A.R.N.